Buying a home in Florida can be stressful, but did you know that one mistake during your loan application can cost you the pre-approval or even thousands of dollars? That's why we bring John Smith from GRA today to clear some questions about it. So John, what do you think is the first mistake that most of the buyers do within the application process?
So I think the biggest mistake is that when people, they start looking for a home first. Prior to looking for the house, they don't work on their pre-approval, they don't do an application, they don't run a credit check. And so the most important thing before you start looking and start spending money on the transaction is to work on getting a pre-approval to make sure that you're good to go on your financing.
Based with that information, how soon should buyers get pre-approvals before start searching for a home?
I believe that buyers should start applying and trying to get an approval for a loan. Somewhere around the 90-day mark is a good time frame. Not everyone gets approved right away. Sometimes there's things that need to be worked on, maybe credit issues, maybe an income or an asset situation that needs to be squared up. And so I think 90 days gives you time in case there's anything that needs to be touched up prior to being able to move into the home at the end of the 90-day mark.
Yeah, in that way when they found the house, so they're ready to
Correct.
put the offer, it's going to be a smooth closing.
Correct, yeah.
Let's talk about credit score. What is the credit score that actually the lenders use and how it can affect the interest rate?
Great question. Credit is so important when you're buying a house and when you're looking to get an approval for a home. So when folks apply for mortgages, we do what's called a tri-merge, which is Equifax, TransUnion, and Experian. So out of those three scores, you've got a low score, a middle score, and a high score. So we'll qualify folks off of the middle score. Now, in terms of the actual credit score, the better the credit score, the better the options in terms of financing, interest rate, costs. So, and then the lower the score, the more that you're going to get beat up on pricing. So, super important to come in with the best credit that you can so that you get good terms on your financing.
So basically, the credit score can affect the interest rate and the closing costs?
Correct.
What's the biggest financing reason that contract fell through in Florida?
So I'd say the biggest reason, it's actually upwards a little over 15% as of July of this year that contracts fell through because of financing. So I think it's really important to work with a good lender who understands the situation and the approval and the client, because you don't want to be part of that 15% and have the transaction fall apart. A lot of those issues with financing can be addressed early on in the process at the time of the pre-approval so that you don't get under contract, spend money on inspections, put money down on escrow, just to have it fall apart for something that you could have addressed early on.
And what do you think are one of the main reasons?
There's a lot of online applications that take place, and I think it's important to have a personal touch to applying for a mortgage. If everyone is just inputting things online but never speaking to somebody and verifying the information, then the approval is not valid. I just had a situation happen a few months ago where somebody had put in the application that they made $50,000 a month, but it was actually $5,000 a month. And so, the kind of house you can get on $50,000 a month is very different than the house that you get if you make $5,000 a month. So,
are adjustable mortgage rate making sense in today's market?
Adjustable rates can make sense, I think, as long as the consumer understands what it is. So, the adjustable mortgage rate will come with a lower interest rate for the initial 3, 5, 7, or 10 years of the mortgage. And so for that time period, you will have a lower mortgage payment. You really have to understand how it works, because if you do, let's say an adjustable rate for 5 years, once you get into the 6th year, things will start adjusting. Now, they could adjust up or down, but you need to be prepared for what may happen after that initial lower payment period on the loan.
So it's a risk, but it's still doable.
It's a risk, yeah. I like doing an adjustable rate mortgage for somebody who has a plan of paying their loan off prior to the rate increasing.
Okay.
Potentially.
What sellers can do to make their property mortgage friendly?
Right now is a very different market. Right now, I think we're in a buyer's market. And so I think, from the seller's end of things, I think it's really important to, when you list the property, to go in at the right price. You want to make sure you come to market aggressive. You want to make sure that the property is in good condition. Any little things, that cosmetically that you can fix very easily, I think you want to make sure that the property shows well. And I think if a buyer comes to you and says, hey, the door needs painted, fix the door.
Just do it.
Just do it. Just
Don't lose the buyer.
try to make it smooth. Buyers are very finicky right now when they go under contract, and so don't give them a reason to walk away from the transaction.
Let's talk about rate buy down. This is basically from the seller. So how different can be if a seller do a buy down?
So we're using quite a few of these right now. It's really good in an environment where interest rates are generally a little bit higher. And so there's two types of buy downs. There's a temporary rate buy down that can get you a lower interest rate for the initial 1, 2, or 3 years. And then there's a permanent rate buy down that'll get you a lower interest rate for the life of the loan. So I think it just depends on the consumer and what they're needing, whether they do a shorter rate buy down or a long-term one. So on a $400,000 loan amount, the consumer can save anywhere from $200 to $400 during the first 2 years on the loan per month. And then a permanent rate buy down, again, you'll get more savings over the life of the loan, but it would depend on how long you hold on to it. So in the long term, the permanent rate buy down would make more sense. In the short term, the temporary rate buy down makes a little more sense.
So we'll just say it's better to ask the seller for a $10,000 to use as a buy down rate, or just $10,000 discount on the price?
I think it's better used to pay for closing fees, but everybody is different. Some people don't care what the monthly payments are as much as what they care what the price is. Some people are more conscious about how much cash they bring to closing, so they'd rather apply that towards closing fees. So everybody is unique in what their situation is.
If you have any other question about mortgage, make sure to comment below and follow us.